Welcome back to Investing Talk podcast.
Today we're looking at NBIS Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of NBIS Group. When we look at this AI infrastructure giant, you really have to look past the usual growth metrics.
Okay.
The real story here is the sheer speed of their expansion. I mean, it's not just growth, it's acceleration. And that's really the entire foundation of the bullish case.
Right. When you look at high-growth tech, you expect big numbers, but
Yeah.
what NBIS Group is doing seems to be resetting expectations for the whole sector. Demand has just gone vertical.
Absolutely. So Q3 2025 revenue came in at $146 million.
Okay.
But the headline isn't really the number itself, it's the rate of change. That figure is a 355% increase year over year.
355%. For context, in an already high-flying sector like AI, that kind of acceleration is, well, it's an extreme outlier.
It is. It confirms that the market demand for their core services, GPU and AI computing capacity, it's not just strong, it's compounding.
So what does the roadmap look like then? Because investors are obviously betting very heavily on those future projections.
And the projections are massive. They're designed to match that incoming demand. For the full fiscal year 2025, NBIS is forecasting revenue to get close to $600 million.
Wow.
Which, translates to a mind-boggling 402% year-over-year increase. And it doesn't stop there.
There's more.
Yeah, their 2026 guidance is already signaling continued hyper-expansion. They're projecting $1.86 billion in revenue. That's another 250% jump. They're trying to almost triple in size again next year.
That is just an enormous runway. But pure revenue growth can sometimes hide underlying weakness, right? If a company is just spending like crazy to grab market share, how do we know this growth is actually efficient?
That's a great question. And that's where the operational story gets incredibly compelling. This is profitable growth. Their gross margin is sitting at 59.12%, and the net margin is very robust at 31.43%.
31% net. In a capital-intensive business like data centers and compute infrastructure, that's huge.
It is. Hitting that while growing at 400% validates that they have excellent pricing power and real operational control. It's efficiency, not just raw volume.
And if they're growing that fast and that profitably, I imagine the analysts are just scrambling to keep up.
They are. We saw proof of this with the Q2 2025 EPS guidance raise. Analysts had to aggressively increase their consensus estimates for 2025 up $2.03.
And when a company has to keep raising its own guidance like that, it's a very strong signal. It means the market is struggling to keep pace with the real-time demand.
Precisely.
Okay, let's shift gears a bit. Let's talk about why they're dominating. Growth like this isn't possible without concrete competitive advantages. And for NBIS Group, that advantage is measured in billions of dollars, right, through these huge strategic deals.
Exactly. Their position isn't built on a lot of small partnerships.
Okay.
It's built on securing these foundational, multi-year, multi-billion-dollar infrastructure contracts. The Microsoft agreement is really the centerpiece.
And that one is valued at up to $17.4 billion.
Up to $17.4 billion, stretching all the way through 2031.
Just think about the scale of that. It's not just a big contract. It structurally de-risks their entire business model for the rest of the decade. It guarantees massive utilization.
And crucially, that deal has a built-in expansion clause. It could potentially go up to $19.4 billion. It really solidifies them as a critical piece in Microsoft's hyperscale AI strategy.
And it's not just Microsoft.
No. Complementing that, they secured a major contract with Meta, valued at $2.9 billion. So when you stack these two agreements together, it confirms their status. They're a key foundational provider for the biggest players in AI globally.
Okay, so here is what I find truly fascinating as a competitive insight from their recent reports. Capacity constraint. The Q3 2025 results show that their data center capacity is basically sold out. Complete utilization. Now, usually that sounds like a problem, but here it's actually acting as a massive competitive moat.
It's a high-quality problem to have, and you're right, because building a data center for hyperscale AI, it takes huge amounts of capital, long lead times, specialized hardware. You can't just spin one up.
It's not a quick process.
Not at all. So if NBIS is already sold out and fulfilling these multi-billion-dollar contracts, any competitor trying to get in faces years of ramp-up just to compete. They've essentially locked in current supply, creating a waiting list for their services.
And to execute on those huge deals and meet that sold-out demand, they obviously need a very strong financial base.
They absolutely do. And their balance sheet is structurally sound. For listeners who aren't deep into financials, we look at things like the Altman Z-score. NBIS is at 3.46.
And then anything over 3.0 is considered very low risk.
Very low risk of financial distress. On top of that, their liquidity is exceptional. The current and quick ratios are both at 6.57.
Meaning they have more than 6 times the liquid assets they need to cover any short-term liabilities. They have the muscle to execute.
What do you do?
Which brings us perfectly to how they plan to meet that exploding sold-out demand. They've been extremely active in the capital markets.
That's the major story of the last quarter. They've been capitalizing on their high stock price and, the investor appetite for AI. They completed a big underwritten public offering of 12.4 million shares at $92.50.
Which injected a huge amount of cash right away. And on top of that equity raise, they also used debt financing.
Yes, they went to the debt markets and issued $1.58 billion in notes due in 2030 and another $1.58 billion due in 2032.
So that's over $3 billion in fresh debt.
Right. And it's specifically targeted at reinforcing their capital for infrastructure expansion. It's a very clear, high-conviction bet on their own growth forecast.
But the forward-looking strategy that is maybe the most aggressive and telling is that equity distribution agreement they announced in October.
This is a very sophisticated move. They partnered with the powerhouse banks, Goldman Sachs, Morgan Stanley, BofA, Citigroup, to set up an at-the-market, or ATM, program.
Explain what that means for our listeners.
It lets them sell up to 25 million Class A shares directly into the open market, bit by bit, whenever they feel the price is right. And crucially, they've stated the proceeds are earmarked specifically for expansion more compute hardware, building out their data center footprint. They're pre-funding their growth pipeline directly from the market.
Okay, so we've laid out this incredibly bullish case, the growth, the contracts, the war chest of cash. Now we have to introduce the mixed signal, which is critical for you, the investor, to understand insider activity.
Right. And it creates a fascinating contradiction. Despite all this incredible news, we saw multiple Form 144 notices filed in September.
Which is the form insiders file when they plan to sell stock.
Exactly. And these revealed large insider sales. We're talking several million shares, including one single transaction that was over $187 million.
That is a giant sale. And the immediate question it raises is, why are key insiders selling at the exact same time the company is aggressively raising billions to fund expansion?
It absolutely requires scrutiny. Now, it could just be personal financial planning, diversification, tax reasons. But when management sells stock, right as they're telling the market to invest heavily for the future, it does raise questions.
But you're saying there's a counter-signal.
There is a strong counter-signal, and it's from the institutional side.
Okay, tell us about that.
Institutional confidence seems to remain very high. Updated filings from major asset managers like Orbis Investment Management showed they either sustained or even increased their ownership during that same period.
So the big long-term money managers are staying put.
It suggests they see the insider selling as maybe an isolated event, not a systemic crisis of confidence in the company's trajectory.
Okay, so this is a highly dynamic, highly capitalized company focused purely on execution. Let's look at the calendar. For investors, the next 3 months are packed with dates that will really test market sentiment.
They are. Starting in December, we have 2 key events. Around the 18th or 15th, there's the index ETF rebalancing. If NBIS gets included or its weighting goes up in major indices.
That automatically forces passive funds to buy their stock, creating inflows.
Exactly. We also have a convertible notes interest payment around December 5th. Then we move into January.
And in January, we get a real read on cash flow with the quarterly holiday revenue update around the 10th.
Right. And then later in January, around the 23rd or 25th, we get the institutional buying disclosures. That'll show us exactly which big funds we're buying in the last quarter.
But the main event is in February.
February is the moment of truth. The Q3 FY 2025 earnings release. It's expected around the 10th or 15th. This is when the market gets confirmation. Are the revenue trends still accelerating? Are the margins holding up? Are they executing on the Microsoft and Meta deals? If they hit or beat here, the stock likely confirms its premium.
And beyond the scheduled reports, what about the rumors? What are the high-stakes catalysts that could pop up unexpectedly?
There are 3 major pieces of speculative buzz. First, potential strategic M&A activity. With the war chest they've built, some analysts think they might acquire a smaller company to accelerate their footprint or tech stack.
That makes sense. It would let them bypass the slow build-out process. What else?
Second, there's persistent chatter about them launching a new full-stack cloud AI platform. This might even involve their own proprietary AI chip. if they move from just providing infrastructure to providing their own silicon.
That would be a game changer. It would move them way up the value chain, expand margins even more.
Dramatically. And third, a real signal of maturity. There's growing speculation that they might initiate their first shareholder return program, maybe a small dividend or a buyback.
Which would be a major shift in their capital allocation.
A huge shift.
Okay, shifting gears one last time before we wrap up, let's talk technicals. For those looking at entry and exit points, how is the stock looking as of November 2025?
It's exhibiting classic bullish momentum. The stock is trading confidently above both its 50-day and 200-day moving averages. That signals broad resilience and a sustained upward trend.
And it's been in a wide range, right? The last 3 months, it went from around $78.2 to $141. What are the key levels people should be watching?
So key support seems to be firmly anchored in that $78 to $82 region. That's where we saw big institutional buying step in on previous dips. Resistance is clustered between, say, $100 and $140. A decisive break above $141 would likely signal a new leg up.
Probably driven by that February earnings report.
Most likely.
Okay, now for the critical balancing act, the risks. When a company is this exciting, the primary risk is almost always baked into the expectations.
It is. And the primary risk, hands down, is the valuation. The forward price-to-earnings ratio is sitting at an astronomical 403.48.
400. To put that in perspective for you, most high-growth tech companies might peak around a PE of 100 or 150.
Right. So a 403 PE means the market is pricing in absolute sustained perfection for the next 5, maybe 10 years. There's virtually no room for error.
So any slight miss on revenue, any delay in capacity could trigger a huge correction because the valuation is just so stretched.
Correct. And that ties directly into the operational risk execution. Scaling a data center business this fast while managing these massive contracts with Microsoft and Meta is monumentally complex.
They need that new capacity online immediately since they're sold out.
You do. Any delays there, and the entire growth story gets questioned. That execution risk is amplified by the sheer speed they're trying to maintain.
And finally, we can't forget the broader sector volatility.
Exactly. Even though NBIS has been an outperformer, AI infrastructure is a high beta sector. You saw the stock pull back 35% recently during a broader AI sell-off. So if the macro environment shifts, even the strongest players are vulnerable.
So, to synthesize this entire analysis, NBIS Group has clearly positioned itself as a structural winner in AI infrastructure. That's evidenced by the unprecedented growth, the strong margins, and those huge decade-defining contracts. They've aggressively raised capital to fund the expansion needed to capitalize on being sold out.
The ultimate test for you, the investor, is watching how that capital gets deployed. That February Q3 earnings release is the singular most critical event. It will confirm if their execution can justify that extreme premium valuation. What's fascinating here is how the debt and the ATM program give them the cash to build now, turning that capacity problem into a supply-side moat. Success will hinge entirely on how quickly they deliver.
Make sure you subscribe to the podcast to stay up to date on all the critical market movers. We'll catch you next time.